In this week's update, a generally disappointing Aussie earnings season, the race between rate cuts and a rapidly weakening US economy, and tailwinds for commodities. My name's Garry Davis. As always, this is general advice only, and please remember to like and subscribe to the video. All right, let's start with our market perspective. The Aussie reporting season has been subpar, disappointing in many ways. There's been some spectacular successes and they've been rewarded in the market, but there've been more misses than normal, and those misses have been punished very severely. So hopefully you haven't been on the end of too many punishing situations, but there's been quite a lot of them. But it's the direct opposite for stocks that have managed to beat the earnings forecast, but probably more particularly to also provide a better than expected outlook as well. And there's been some very spectacular gains, and WiseTech Global amongst the top 100 stocks is certainly one of the standouts with, I think they were up about 20% or something on the day that they reported. So a very large diversity in results in the Australian reporting season. So the solution is very simple. Obviously, you need to focus far more on the stocks that are highly likely to produce positive results. The growth is going to come through. It's impossible to get it 100% right, but there are some core basics that I talk about quite regularly, both in this video, but also within the memberships. There are common criteria that the best of the best stocks have. And if you just focus on identifying stocks that have nearly all of those criteria, then the bulk of what you do should work out pretty well. So it's a very simple process. It's not easy because there's a lot of legwork and a lot of commitment and conviction required to do that, but it's certainly where your focus needs to be. Now, if we look at the outlook statements, resources companies are struggling, definitely, but IT and healthcare are forecast to be the outperformers. That's where the strongest outlooks seem to be. Broker revisions, there's been a lot of broker revisions downwards. That's probably the low light of Australian earnings season. So you really do need strong conviction around what you own to make this work. Now, where do you get strong conviction from? Well, you get it from clarity of purpose, which comes from your game plan. You get it from having perspective refreshed regularly so that you don't lose sight of the important factors. That's where your strong conviction has got to come from. Now, there's some new data out in the US. Things are moving around very, very quickly. In the US, it was only a week ago, it looked like we had a real Goldilocks situation on our hands in America. But then a revised jobs number came out for March ending 2023, and it was down by 818,000. Now, I don't profess to understand all these revisions that they do in the US economic stats by any stretch. But this was a 30% variance to where they were or what was expected. It was the second largest revision in the history of the Labor Department. So this was very, very significant and obviously is a huge economic negative. So the jobs market is much worse than was expected. Of course, the ramifications for that are obvious. It just trickles through or doesn't trickle through. It's going to absolutely cascade through everything. So the big question now is that there's no question the Fed have got to cut in September. The question is whether they do 25 basis points or they do 50 basis points. I think if they do 25, the market may react badly to 25 because this jobs number or revision has been a real wake-up call that things are not going nearly as well as what was thought. So 50 basis points is probably more now what the market is expecting. And now it's a race. Will the earnings cycle? And there are some expectations now that there'll be 100 basis points of rate cuts before the end of the year. So they won't get 425s in. So if they're going to achieve that, they're going to have to do some 50 basis point cuts, perhaps 50 in September, another 50 in November. So will that easing cycle beat off a recession? Because if that revised jobs number is indicative, truly indicative of what's happening in the jobs market in America, then America could slip into a recession quite easily. And of course, there's always a lag with rate cuts. Will they have the desired impact quickly enough? So don't underestimate it. This jobs number is a big deal. I'm surprised that it's not getting more media coverage, to be honest. So when we look at America, what are the areas that are at risk? Well, the consumer, obviously, anything to do with the consumer. If jobs are falling significantly, then that's going to affect travel. It's going to affect restaurants. It's going to affect certainly higher end retailing. May even get down into some of the more basic retailing areas as well. It's certainly going to filter into transportation, because transportation is a reflection of the level of economic activity. So there's definitely going to be an impact there. It's potentially impacts almost all cyclical businesses. So you've now got to be very, very careful about what parts of the American stock market you're in. You've got to find the sectors that are going to be relatively resilient. We spent the last 2 or 3 years focusing on stocks that are resilient to inflation because they've got pricing power. And that will still be the case to a degree, but resilience to an economic slowdown and or a recession needs to be put on the agenda as well. And there are some stocks that are in that position. Stock selection, even more critical now. The S&P had a good week, a couple of wobbles during the week, but 3.2% up. The NASDAQ 1.1, the equal weight S&P up 2.1, and the Russell did really well, up 3.7. So that rotation out of the big end of town into smaller and mid-cap stocks is continuing. Good to see. So overall, it was a strong week, as we'll see on the chart in a minute, with just a wobble or two during the week. The US dollar index, because of the expectation around what the Fed will now do with interest rates, was down quite sharply, dropped about 2%, down to 100.5. That pulled the 10-year yield down to 3.8, and even the 30-year yield has come off as well. And the VIX did kick up a little bit. It was about 14.5 last week and back almost to 16. But look, that's still relatively low. There's nothing untoward about the VIX in that vicinity. There's the S&P on a weekly chart. So after the big panic on the 5th of August, where we had this massive gap down, it's been plain sailing all the way back up. And this was the highest weekly close ever at 56.34. So that's looking particularly robust. There's the equal weight S&P, also had a good week, and you'll notice that they're finishing right on their highs. So the buying went all the way into Friday night, and that enthusiasm was for the expectation that the Fed is now virtually a done deal to cut rates. But I am a bit surprised that that revised jobs report didn't have more of a negative impact on the market. But anyway, we shall see. And there's the Russell, finished very well on Friday. You can see spiked up quite nicely, and the volumes were good as well. And just to complete the picture, there's the NASDAQ on a daily, and you can see the impact now. Go back to the S&P. The S&P new all-time closing highs, and the NASDAQ on a weekly looks that way. So we're not. We're still below the prior high. So you can see right there the impact of the selling pressure, particularly in the big technology area. Semiconductors just sort of holding their own. They're well down from their peak, but they're not falling away again. It was a bit of a negative session on Thursday, but managed to pick up a little bit. But certainly, I think with the NVIDIA earnings report next week, that'll go a long way to determining where to for the tech sector. And if we look at the relative comparison charts over the last month, communication services still at the top, but so's staples. So there is certainly a level of defensiveness in the US market. And then we've got financials and XLK, which is the technology index, and then followed by healthcare and energy right at the bottom. So that's the US market. The Australian market, not a lot different in some respects. Energy really on the nose in Australia and was way down. Materials had a better week, but still towards the bottom of the pecking order. We've got healthcare picking up, finance just overall on the rise, but a bit weak towards the end of the week, but of course the star of the week was information technology in Australia, particularly around WiseTech Global, but a number of others as well. So that's where we sit with the US market. Aussie stocks, the dollar bounced up really hard, obviously, with the US dollar going down. We'll take a look at that. The ASX 200 was up just over 0.5% for the week, but I would expect that we'll probably make some more gains at the index level on Monday, and we broke through 8,000 and managed to close above it on Friday. The information technology sector up nearly 10%, huge week for that sector. Let's go and have a look at some of those. We'll just have a quick look at the currency. There's the US dollar down sharply, and if you pan back, you can see this is a very important support level. We go back to the last time we passed through this level on the way up was in April 2022, some 15, 16 months ago. So this is a very important support level here, around 100 to 100.5. The Aussie dollar, of course, did the opposite and finished quite strongly, almost up to 67.5. Okay, while I'm here, let's have a look at gold. So there's the gold chart on a daily. We did set a new all-time high at 25.32 during the week, finished at 25.09 with certainly some selling on Thursday, but you just got to step back and look at that chart and it's trending up. There's a fair bit of volatility, but the trend is definitely to the upside. In Aussie dollars, it looks that way. Obviously, the rise in the Australian dollar more than offset the US dollar price. And just to finish off, there's silver almost back up to 30. Just summarising, just on the Australian market, there really are some fabulous trends. So whilst earnings season was disappointing, there are some stocks that are continuing to do exceptionally well. And importantly, not only have they got strong positive trends, but those trends are being backed up by excellent fundamentals. This is not a market where hype is carrying the day. It's not that kind of market at all. The market's not interested in that at the moment. Stocks need to be really producing not only good fundamentals for FY24, but their outlooks have got to be really solid as well. And there are certainly some stocks that are delivering. So precious metals, gold steady at 2509 in the end, 36.95 in Aussie dollars, and silver almost back to 30. Precious metal stocks are making some headway. There's a few superstars, but not many. But in Australia, the trends are a little bit better than mildly higher, but they're certainly, you wouldn't describe them as significantly higher. So they're just plodding away to the upside. Nothing terribly exciting there, but there are some stars. Okay, other commodities. Copper was up. This is really currency effect. 421 on copper, nickel, 747. And crude oil was down, however, to 74.83. So just skipping through the charts quickly, there's copper rebounding from just a tick under $4, which was very important support. And there's the crude level. So wrapping it up, there's two potential big negatives in the US market. Neither of them may impact equities, but the odds of them impacting equities have certainly risen and risen significantly. So this is not a prediction that we're going to see anything nasty in the US market, but the probabilities, which is all that we've got to work with, the probabilities are now significantly higher. That means you really should be just a few notches more conservative in how you do things. And those two negatives, we've got this battle between rate cuts. Will they come soon enough? Will they have the impact soon enough to offset a clearly deteriorating jobs market? And that has huge ramifications for the whole US economy. And the second thing is, if the Democrats win, if they're able to enact some of the policies that they're talking about, then it will be a less business-friendly environment in the US, and that cannot be good for the stock market. That's pretty simple logic. So what do you do when it's an uncertain environment? You don't know how the election's going to go. You don't know what the Fed rate cut cycle is going to do. So many unknowns. What do? Well, you fall back on the only things that we've got, and that is you can control what we can. And in my experience, when you look across all of the factors, we can control far more than things that are out of our control. We can control the stocks that we buy. We can control when and how we buy them. We can control how we weight them. We can certainly control how we take profit and how we protect capital. So many things that we can control. So focus on that. And the most important one is the stock selection. Zero in on stocks that have got an overwhelming probability that the business will continue to move forward strongly because it just has all the factors in place. And as long as you don't pay too much when you buy into that business, that stock, then you should be okay. You might get short-term dips, but the long-term should be fine. So that's what we do in uncertain environments. Portfolio analyst last week was about, just what to overweight. So if we're in a tough and we're in a volatile market, there's no question about it. There's just so many things could go wrong, so many geopolitical issues that could destabilize. So it's a tough, tricky market. But the stocks that are going to go up strongly with a very high degree of probability, you really should be looking at those being your heaviest weightings. What do we overweight in that sort of environment? And there was also several potential buys listed as well. If you haven't taken the portfolio analyst trial, it's $1 for 2 weeks. There's a huge amount of education and valuable perspective and learning in that, worth a try. That's it for this week. More information on the website. Here's my email address. I'll be back with you next Sunday. Cheers.